Hi, and welcome to this week's market presentation. Price evolution. In the latest price evolution over the past week, we see further upward movement across natural gas, oil, and electricity markets in Europe. The biggest gains have been seen across natural gas and electricity prices in Europe, starting with the front month and extending through the rest of 2026 and 2027. Latest news. Looking at the latest energy news, hostilities between the US and Iran continue to escalate over the past week, pushing crude oil prices over $90 a barrel. US and Iran resumed direct military strikes for the 9th straight day, with Iran claiming the lives of 2 US service members in Jordan, and the US extending military airstrikes against infrastructure such as bridges in Iran, which then resulted in Iran beginning to target civilian infrastructure in neighboring countries as well. Traffic through the Strait of Hormuz has dropped to virtually zero, and now we have seen a further escalation with the Iran-backed Houthi rebels striking Saudi Arabia as Iran attacked a Kuwaiti power plant. Iran has also warned that it may ask the Houthis to close the Bab el-Mandeb Strait, which would force transit through the Red Sea and the Suez Canal to reroute to longer routes. Overall, energy markets globally facing additional pressure now from the renewed halt of transit through the strait. Crude oil prices surging at the largest weekly gain since April, and natural gas prices in Europe and Asia seeing rapid increases there as well. Global LNG supply now faces the first contraction since 2012. Over in Europe, heat waves pushed the power system to its limits. Exceptional heat waves over the past week drove record cooling demand across Western Europe, also increase in river water temperatures, resulting in widespread nuclear power curtailment, with a record 9.2 gigawatts of French nuclear capacity being cut due to the higher temperatures. Additionally, low water river levels on the Rhine restricting coal barge deliveries inland. The impact has been a spike in spot power prices at times, with German evening prices nearing 300 euros a megawatt hour. The German frontier power price now hitting a 2.5-year high. French summer and calendar year power contracts also reaching record highs as fears grow over summer supply reliability and winter hydro levels. Lastly, the European Commission published its ETS review package for the post-2030 era. Most importantly, as part of the carbon market reform, the annual emissions cap reduction will be slowed after 2030 from 4.4% to 3.7% through the first 5 years of the decade, and then slowing to 1.7% in the later half of the 2030s. The phase out of free allowances for industry has also been postponed to 2038. And then the rules for the Market Stability Reserve will be adjusted, with an intake rate going from 24% to 12%. Overall, European carbon allowance prices were highly volatile ahead and right after the package was released, fluctuating between 77 euros per ton and 81 euros per ton. The proposed reforms are seen as more flexible and certainly more bearish for the long-term supply outlook, particularly given the slower rate of the annual emissions cap reduction, as well as the phase-out of free allowances for industry. NGOs and other environmental groups have criticized the slower cuts, stating that this will only allow for more pollution out of the industrial and manufacturing sectors. Even in the face of these proposed reforms, given their time frame, the carbon market's near-term focus remains on the existing natural gas supply crisis out of the Middle East and its impact on European gas prices, as well as the overall macroeconomic impact. Weather. Looking at the latest weather forecast, we see temperatures moderating over the course of the next 7 to 10 days, with temperatures across most of Europe moving closer to slightly below the seasonal average. Precipitation is still expected to remain limited throughout most of this week before starting to pick up as we move through the next 7 to 10 days, particularly over northern and south central Europe. Wind speeds are expected to pick up at the beginning of this week, leading to a boost in wind power generation before easing off again throughout the majority of the remainder of the week. And lastly, as we look to the Atlantic hurricane season, we now see a depression forming in the Gulf. At the moment, nothing concerning out in the horizon. And given the emergence to the El Nino weather pattern, forecasts are indicating a calmer hurricane season this year than in past years. Microeconomics. Looking at the macroeconomics, the Chinese GDP figures released for the second quarter of the year showing a slowdown in economic activity and economic growth in the Chinese economy, with year-over-year growth down to 4.3% for the second quarter, largely driven by the outbreak of war in the Middle East and the impact that that has had on global oil prices and the Chinese economy. Inflation rates for the Euro area and the US released for the month of June showing a decrease in inflation, largely due to the decrease in oil prices that we saw in the second half of the month. Now, as tensions have once again restarted in the region, we could start to see inflation creep up again in July if the conflict persists longer into the month. Overall, the slight drop in inflation over the month of June expected to ease pressure on central banks to increase interest rates once again, the Euro area having done so already this year, while the US Fed remaining more cautious when it comes to changes to the current monetary policy. Crude oil and LPG. Looking at crude oil markets, we note the sharp increase in prices over the past week, up nearly 16% for Brent, nearly 15% for West Texas crude, very much directly linked to the resumption of open hostilities between the US and Iran and the halt of transit through the Strait of Hormuz. US stocks have continued the downward trend over the last few weeks, with the Strategic Petroleum Reserve once again pushing new decade lows, now near the lowest level since the early 1980s. Again, as hostilities resume in the Middle East, it must be noted that the cushion that inventories were providing markets over the past couple of months have narrowed significantly, reducing just how much more inventories can be withdrawn from markets without putting the stability of those reserves at risk. Natural gas. Looking at the price evolution of natural gas, we note the nearly 18% increase in the price level for the front quarter, the last quarter of 2026, up nearly 18%. The frontier up 12% over the past week. For the frontier, pricing is now moving closer to the peaks that we saw back in March and April. And certainly as we continue to see the halt of LNG exports out of the region, we're likely to see additional upward pressure on the market. Adding to the upward pressure on European natural gas prices are also the below average storage levels. Storage inventories remain at near 13-year lows, with the rate of injection continuing to fall behind that of last year, pushing the deficit versus 2025 higher over the past week. Overall, the injection rate remains just slightly below the past 13-year average, quite stable over the last month and a half. In terms of total supply and demand, over the past week, slight increase in total demand driven by the higher temperatures across Europe, while total supply, while seeing a slight increase versus the low we saw about a couple of weeks ago, remains at 5-year lows. Looking at the European supply mix, we note that fortunately Norwegian gas flows remain at the top of the past 5-year range and at the levels we've seen over the last couple of years, while LNG send-outs and particularly LNG imports into Europe remain at multi-year lows, very much driven by the steep price competition with Asian consumers for US LNG exports, which over the past few weeks have come down following outages both at the Freeport LNG terminal and at Golden Pass, reducing overall export capacity. If we look at the investment fund positions, we see a renewed uptick in the level of long positions following the resumption of hostilities between the US and Iran, and a reflection of the upward trend that we're seeing in market prices over the last couple of weeks. Coal. Looking at coal prices, we see an uptick, especially looking at the API4 and the Newcastle index for the front year. The API2 index seeing slightly more modest gains over the past week. Over in Europe, the uptick in natural gas prices certainly resulting in additional competitiveness for coal-fired power plants, increasing consumption and future demand expectations. On the other hand, the lower river levels at the Rhine limiting coal transports from ports, with coal stocks at ARA terminals still at comfortable levels for this time of year. Over in Asia, we are seeing slightly lower demand domestically, especially in China, particularly as we see an uptick in hydropower generation and the outlook there due to additional increases in hydro storage levels there, reducing some of the demand for additional imports. Over in India, we're also seeing a preference for the domestic production there. But overall, as the situation in the Middle East continues, further increases and dwindling supplies of LNG could certainly spur additional demand for coal imports, both in Asia and in Europe. If we look at fossil generation in Europe, we do see that uptick in hard coal and brown coal power generation over the past week, very much a reflection of the uptick in spot natural gas prices, but also the uptick in demand for fossil fuels as a result of the output from non-dispatchable sources of electricity, as well as the higher total demand. EU and UK emission allowances. Looking next at carbon allowances, we see market prices on the European side of things relatively steady over the past week. As we mentioned earlier, quite a bit of volatility during the trading sessions over the past week, but overall market remaining steady week over week. On the UK side of things, seeing a further uptick in the price level, pushing the UK spot price now near historical highs at very high levels. We look at power sector emissions, we see an uptick over the past week, again, very much driven by the higher temperatures resulting in additional power demand, but also the shift in the power mix with additional demand from fossil fuels, especially coal-fired power generation, increasing overall emissions. Investment funds on the European side of things, decreasing the level of long positions in the market as a response to the ETS market reform proposals, which, as mentioned earlier, are indicating or leading to a more bearish sentiment, especially further along the curve. On the UK side of things, positions remaining at near record high net long levels. Electricity. Looking towards electricity prices, once again, seeing the overall bullish price evolution over the past week. Looking at the German power market, we note the sharp increases over the past week. The last quarter of the year up 10% on the week, the front year up 7.4% on the week, with the front year now pushing up to a new high of a price level with prices just under 105 euros per megawatt hour. The increase The increase in power prices in the German power market very much driven by the surging natural gas prices over the last couple of weeks, pushing up generation costs. The emergence of heat waves across Europe, which have again increased demand, particularly for fossil fuels, there have also added to the summer risk premiums being added onto the market. If we look at the price evolution across European markets, we see a similarly upward trend across European markets and in the Nordics as well. Looking at total grid demand remains at the top of the range over the past 5 years, with a slight uptick over the last week, in part due to the higher temperatures. In terms of the supply side of things, non-dispatchable demand having decreased versus the peak seen a couple of weeks ago, which have in turn resulted in an increase in the residual load. Taking a closer look at non-dispatchable demand, we see the drop in wind power generation just starting to recover over the last couple of days. Thankfully, solar power generation remains at a record high, pushing up and compensating for the poor wind power generation and hydro run-over-the-river output. On the residual load and dispatchable supply, we know that uptick in fossil fuel generation, as we saw earlier, driven by increases in both natural gas-fired power output and coal-fired power output. Nuclear power generation having seen a decrease versus a week to 10 days ago, largely driven by those curtailments as a result of the higher river temperatures and cooling requirements. Lastly, hydro reservoir generation remaining near the bottom of the past 5-year range, with the current outlook remaining poor, especially in the Nordic region, given the lower hydro storage levels. And lastly, looking at guarantees of origin, we note the upward movement over the past week, with prices increasing noticeably week over week, pushing up once again from the trend that we were seeing over the last few weeks. That covers this week's market presentation. Thank you for joining.